Our mission today is pretty straightforward. We're diving headfirst into a towering stack of analyst reports and strategist notes.
A big stack.
A very big stack. And we're going to get you, the listener, fully up to speed on the core risks that are really defining the U.S. equity market for 2026.
And our source material today, it all seems to circle around one central problem. How Wall Street strategists are trying to quantify something that's, notoriously hard to trade.
Policy uncertainty.
Exactly. This whole unprecedented political cycle. And it's not just some vague political risk. We're talking about the chaos from policy statements, things that might not even become law.
But they're still having these immediate real-world financial consequences.
Right.
And as you know, Wall Street just loves its catchy acronyms. We've had FAE, we've lived through FOMO and YOLO for sure.
Yeah.
We even had TACO for those early trade war threats. But there's a new code word, and it seems to be dominating all the risk conversations for 2026. And that code is big MOS.
And that is precisely our mission. We're here to unpack what big MAC really means, why strategists felt they needed to create it now, why the old ones just don't fit anymore,
No.
and most importantly, how this specific type of uncertainty is already causing some pretty dramatic targeted volatility at the sector level. We're going to have to look past the calm surface of the big indices and see the shock waves underneath.
Okay, so let's get right into it, the definition. For those of us who haven't been reading strategist reports all week, what exactly does big MAC stand for? Who came up with it?
So Big MA stands for Big Midterms Are Coming.
Okay.
The concept comes from Ed Clissold. He's the chief U.S. strategist at Ned Davis Research. And what Clissold is arguing is that Big MA really encapsulates the central theme for the 2026 market, which is the financial impact from policy movements or, just the threat of them all in the lead up to the congressional elections this fall.
And what's the engine behind it?
Well, what's critical to understand is the political strategy. The president has been firing off this huge flurry of policy statements. A lot of them are on social media. They don't have immediate legislative power.
Right, they're not bills. Not
at all. But the goal is transparently political. It's about boosting the party's chances in November by aggressively targeting what they're calling the U.S. affordability crisis.
So hitting those pain points the voters feel. Credit card rates, gas prices, that sort of thing.
It's the strategic handle.
Yeah.
And that's what's causing the market to react.
Which brings us back to that old acronym you mentioned, TACO. That was Trump always chickens out.
Yeah.
It was about tariff threats that, well, they didn't really happen.
Yeah, and the reports are saying TACO is now out of fashion.
So why the shift? Why isn't the market treating these new threats the same way?
It's really about the scope and the execution. The TACO era threats were, they were mostly external. Tariffs on China, other trade partners. They were very visible, often postured, and a lot of times they were negotiated down before any real damage happened.
Okay.
But these recent threats are domestic. They're targeted at these high-profile voter concerns, and crucially, they are having an impact.
So the signal is just strong enough this time?
It's more than strong enough. I mean, when the White House singles out a hugely profitable industry like banking or defense and demands these radical changes, even without a bill, analysts are forced to completely rerun their models.
So they can't just ignore it as political noise.
They can't.
Yeah.
The market has to price in a clear political targeting signal that could, eventually become regulation. These threats aren't chickening out. They are landing directly on company balance sheets.
So for a big institutional investor, Big AM isn't really a trading strategy you can act on. It's more of an undeniable market theme. Is that right?
That's a perfect way to put it. It's a theme, a factor risk. Clissold emphasizes you can't build a clean hedge portfolio against Big MC. How do you hedge against a social media post that could wipe out 15% of a sector's profit overnight?
You can't.
You really can't. The speed and the specificity of the shock just make it impossible.
Okay, so let's get into the evidence. Let's move beyond the concept. Where have these statements actually landed and caused, real immediate market damage?
Well, the source material gives us 3 major examples that cause just instant, measurable volatility.
Okay.
The most dramatic one was the hit to the banking sector. The president demanded that credit card issuers cap their interest rates at 10%.
10%. For context, the average rate is what, closer to 30%?
For many people, 28-30%. So demanding a 10% cap isn't a small tweak. It's a signal of, frankly, systemic profit destruction for that whole market.
And the result was immediate.
Instant. Bank stocks dropped sharply. Institutions had to adjust their risk models on the fly.
But again, why aren't they just ignoring this? If it's not a law, why not just call it political noise and move on?
Because the market prices in future risk, and political will is a massive future risk. Even if Congress blocks this specific demand, the signal has been sent. The administration has found a profitable pressure point and shown they are willing to intervene.
So it changes the whole environment for the sector going forward.
Exactly. It makes future regulation, even if it's less extreme, seem far more likely. We saw a similar thing in the military and defense sector.
Right, the dividends.
The dividends. An order was issued for contractors to stop paying dividends and instead redirect that capital into production. I mean, that is direct government interference in capital allocation. It just completely disrupts the shareholder return model.
And defense stocks got hit hard.
Of course. Investors rely on those dividends, and it signals this potential for long-term government meddling in how these companies are run.
And the third example was a bit broader, right? It was more about sentiment.
It was. It hit broad financial sentiment when the government started publicly criticizing the independence of the Federal Reserve.
And its chairman.
And its chairman. Wall Street sees that as a direct attack on monetary stability. You can just feel the nervousness shoot up across the board.
So Clissold, the guy who came up with Big MAC, he's pointing to financials as the biggest risk area now.
Yeah, he sees it as the most explicit risk, mostly because of all the political capital being spent on targeting mortgage rates, credit card rates, all aimed at that affordability crisis narrative before the midterms.
And the timeline here is key. Michael O'Rourke at Jones Trading points this out. We've got, what, 42 weeks until the elections?
42 weeks. That is a ton of time for the White House to launch more of these targeted strikes against other industries.
Which creates this huge vulnerability because O'Rourke says the market is already perfectly priced, valuations are stretched.
Exactly. So if, say, big pharma or major food producers could get targeted next week, a big fund manager has to ask themselves, my valuation is already aggressive. Why am I sticking around to absorb this unpredictable political risk?
And that hesitation, if everyone has it at once.
That's what triggers a mass sell-off, easily.
This feeds right into another big concern strategists have, market complacency. Tom Essay from the Sevens Report talks about the market becoming numb.
Yeah, and Essay's point is it's a bit nuanced. It's not just that the market is shrugging things off. It's that its apathy might actually be encouraging more aggressive action from the government.
So the lack of a market freakout is sort of a green light?
In a way, yes. If there's no high costs, no big sell-off for creating all this uncertainty, then there's less incentive for the administration to pull back. So while we haven't seen catastrophic damage yet, Essay is basically arguing this numbness is what will eventually lead to major damage. It just keeps feeding the cycle.
That makes perfect sense. And if we zoom out from this specific situation and just look at history, midterm election years are always tough for stocks, aren't they?
Always. It's a structural challenge. They generally have lower than average returns precisely because of this kind of policy uncertainty.
There's real data on this, right?
Oh, yeah. The numbers are pretty sobering. Sam Stovall over at CFRA, he points out that historically the S&P 500 sees an average annual drawdown, that's the peak to trough drop, within the year of a massive 18% in midterm years.
18%. That is a huge drop. So strategists are basically factoring in a major correction just because of the calendar.
They absolutely are. That 18% reflects all the de-risking that happens as investors see a potential political shift coming. Nobody wants to be fully exposed when the whole landscape could change.
And it gets worse depending on who controls Congress, doesn't it?
It does. There's another data point. Since 1945, in years where one party controls the White House and both houses of Congress, and so they're at risk of losing that control, the average annual gain for the market is only 3.8%.
Wow.
Yeah. And nearly half of those specific years actually ended with losses. So it's a tough environment even before you add this whole Big Maxi factor on top.
So you have these two forces coming together, the historical drag of a midterm year, plus this new unpredictable factor of targeted policy strikes.
Yeah.
The risk isn't just a new policy, it's a perfectly priced market panicking.
The risk is real. But what's key, and Dennis DeBashir at 22V Research really highlights this, is where the volatility is concentrated. So while the macro volatility on the S&P 500 index itself looks low, deceptively stable, the actual effect of these headlines is almost entirely focused at the individual stock or sector level.
And what's the measurable difference? Why is that gap so big between the index and the individual stocks?
The data is stark. Debuscher's research shows that because of these political factors, the actual volatility in individual stocks is nearly 22 percentage point higher than the volatility of the broad index.
22 points. That's a massive gap.
It's huge. And the reason is twofold. First, the index is diversified, right? So a shock to banks gets offset by calm in utilities. But second, you have algorithmic trading.
Of course.
The second, a policy statement targets a handful of defense contractors. Those algorithms start selling that specific sector instantly. It causes huge swings in those stocks before the macro index even moves. It means you have to do your homework stock by stock.
And this kind of risk, it's starting to affect how investors think about the U.S. market versus the rest of the world.
Absolutely. The general nervousness about political interference, things like the judicial attacks on Powell, as they call it, it's pushing up the U.S. equity risk premium.
The extra return you demand for taking on the risk.
Exactly. And because U.S. stocks now carry this higher political premium, you have strategists at places like Scotiabank predicting that global stocks might actually outperform the S&P 500 in 2026. It's a direct result of capital looking for less politically volatile places to go.
This whole environment sounds like a complete nightmare for a short-term trader. So if you're a serious, active investor, how do you even manage this big MAXC risk?
Kimberly Forrest at Boca Capital Partners had some thoughts.
Yeah, her advice is pretty straightforward. It basically comes down to brute force patience. She says you need to adopt an investment horizon of 3 to 5 years.
So long enough to ride out the entire political cycle.
Precisely. To bridge the current cycle and just ignore all the short-term noise from social media and policy statements.
But isn't that just kind of hoping for the best? What if this becomes the new normal? Well, her view is that political noise, even when it's this loud, rarely overrides fundamental demand over a multi-year period. And she gave a great real-world example. Her firm holding ExxonMobil.
Right, they got some heat from the administration over Venezuela.
They did, but Forrest's long-term thesis is simple. The global demand for energy 5 years from now is a much bigger deal than a short-term political spat over Venezuelan oil.
So she sees it as a long-term hold, insulated from the day-to-day drama.
Exactly. She basically told analysts, I don't care if they enter the Venezuelan market this week. It's that willingness to take short-term political hits for long-term fundamental value that is the core defense against big MS.
It sounds like her advice to anyone trying to trade this stuff short-term is not optimistic.
Brilliantly realistic, I'd say. She summed it up for short-term funds in 2 words.
Oh, good luck.
Good luck. The message is crystal clear. Trying to trade these headlines is just excessively difficult when the political risk is this surgical and this unpredictable.
This has been a really critical deep dive. I think the core takeaway for you, the listener, is that big MACE isn't a trade. It's a red flag. It's a signal that this unhedged policy risk, driven purely by election strategy, is now a dominant factor.
And because the volatility is so concentrated at the stock level, that granular sector-by-sector research has just never been more important.
Right.
So to synthesize everything we've looked at, even if the broad S&P 500 looks resilient, the combination of that historical midterm drag and this new, highly specific policy targeting makes this market fundamentally different. It really penalizes a short-term focus and demands a ruthless assessment of your political exposure.
So here's the final provocative thought we want to leave you with. Our source material shows that the market's numbness, its initial apathy toward these policy shifts, might actually be encouraging more aggressive government action around this affordability crisis narrative. Considering that escalating risk, where is the next politically sensitive policy measure most likely to land? Which specific sector is most vulnerable to being the next big MAS target, now that finance and defense have already felt the shockwaves? Where does that political calculus meet market vulnerability next?